the guaranteed delivery of future money, the death benefit, I know it's happening, is just as valuable as having that money today, as long as you have assets or credit available today to use against that eventuality. And here's what I mean by that. If I know my kids are going to get $1 million to split, or whatever the number is, that means I've got $1 million in my hands today that I can just completely squander. I could just bet it on black if I wanted to and know that my kids are still taken care of. Similarly, because that policy has an available cash value, I know that I can keep that $1 million that's in my investments invested in the market, because if it goes down, now I've got a bucket of money to pull from to let my portfolio recover.
One of the things that I don't think enough people know is, the typical portfolio that most people have, and one that has been touted as the best portfolio, was the 60-40 split, 60% in equities, 40% in bonds. What they probably don't know is the fact that it's like the worst performer in the last 100 years. And we're starting to move into this different world in our wealth sphere that people have got to really start taking a strategy approach rather than just all it is just a product approach.
Many investors, all they have is an investment portfolio, and they don't know how long that investment portfolio is going to last, because they don't know how long the game is going to last, if they're going to be dead in 15 years or 50. That said, how differently do you think they would approach retirement if they had a reliever in their portfolio? If they knew if they did happen to retire into the worst case scenario and there was a world war 3 years into their retirement, or just fill in the blank of bad things that could happen, if they had some relief asset that would put guarantees in place so that no matter what, they're protected. They would spend a lot more aggressively. They would stop under enjoying those early years of their retirement and maximize the income that they could live off of, which again is the stated goal of retirement accounts.
Tom, I'm excited to have you. We are just on episode 2. Last week, we talked to Garrett Gunderson on Board of Titans, where I really just get to have a conversation with Titans in my life, but they're not only just Titans in my life, but Titans in the industry, which you are. And I'm excited to talk about what we're going to get into today.
Yeah, likewise. Thanks for having me, Brock. Love being with you.
Yeah, you as well. So before we get into anything, what I like to talk to a lot of people about is the fact that you're not just some life insurance agent. You're not just some advisor. You're a guy with a PhD. You have master's degrees. You've got all kinds of recognition about how smart you are and why you're in this industry. So why don't you tell us a little bit about who you are real quick, where you came from, and why should somebody listen to you?
Yeah, so I actually was an advisor 22 years. I started in the business 22 years ago as an advisor right out of college, frankly, selling life insurance just to start, with one of the big major mutual companies, before quickly, getting my investment licenses and financial planning and all that and becoming a full-fledged advisor. And after about 4 years of doing that, actually joined one of the major mutual life insurance company home offices and became a product expert, effectively training advisors, thousands of advisors around the country on the core concepts and principles behind it. And, during that journey, I struggled with the fact that I was on stages in front of really smart, really experienced advisors. And it led me to continually, study, build professional designations. I did end up getting 2 master's degrees while, living in hotel rooms 100 nights a year during that phase, which, eventually did lead to a PhD in retirement income planning. And I was just so blessed to study under a lot of the smartest minds in the business while doing that. So I'm not an advisor right now. I actually don't earn anything working with clients. I exclusively coach advisors now. About 4 years ago, I decided to leave that home office life and go back out into what I call the field, with advisors, talking about how to position this stuff effectively. At that time, I published my first book called Permission to Spend in Retirement, which was, kind of the outgrowth of a lot of the studying that I had and original work that I had created in that PhD program. And now I travel the country, and I'm quite literally on an airplane on average weekly to a different city, giving a different talk. And in the process, I've actually organized a large study group of about 1,400 advisors, talking about these core concepts, language, how to apply this, and the science around why this stuff actually fits versus just being a sales pitch that sounds good.
Yeah. Well, I can tell you, as somebody in your mastermind group, I think, or study group, I think it's one of the best that you can be a part of. So if there is an agent watching this or listening to this, they need to join. But you did write this book, Permission to Spend. It's easily in my top 5 books. I sent you a picture of one of my clients that sent me a picture with his daughter with one of these books, and he laughed and he said, I don't know if she's taking it the same way as I take that same permission to spend. Um, so, Tom, I think we already let the cat out of the bag about the fact that we're talking about whole life insurance. So let's address that and talk about the fact that you have this PhD in retirement income and you write a lot and share a lot and talk a lot about whole life insurance. And whole life insurance across the board is talked about just in a negative light. People all over the place talk about how you don't need to get it. It's the worst investment you could ever make. It's a bad decision, and you should either do an index universal life insurance policy, which is becoming very hot right now with social media, or which is the older argument, which is, hey, you just need to buy term insurance, and then whatever you have, you just need to invest the rest of that. So, why don't we address that? What is your thoughts around those conversation pieces?
Yeah, it's a big topic. There's a lot to that. Um, I'll start with buy term, invest the difference. So for those of you, for anyone that's less educated on the topic, whole life insurance premiums can be anywhere from 10 to 30 times what you would pay for a similar death benefit in term insurance. So why would you do that? Like, why wouldn't you just buy the cheap term insurance and then invest the difference elsewhere? It makes sense when you think about it that way. Term insurance is like renting your insurance, but the reason it's so cheap is because you're not going to die during that period of time. Like there is that 1 in a million chance that you collect on that. But the reason they sell it at such volume and for such a low amount is because it's not going to happen. So that aside, there's the reason that whole life insurance makes a lot of sense is it's not actually about needs. Like in the younger, when my kids were young and I was the sole breadwinner for my family, I still didn't need life insurance. My spouse would have remarried. They would have survived. They had a family with some assets. But for me, it was a need because I felt obligated to leave my family as well off as they would have been with me. I wanted my kids to have the life that I envisioned for them. So the need is perceived. And then I think on a bigger case, on a bigger level, when you think about it in retirement, it becomes a want. All right. And the reason it's a want in retirement, and this is what my book is all about, is, when you get to retirement, you are going to be terrified to spend. It's actually the first line of the book. You will be afraid to spend. It was a puzzle that I discovered very early on in my career. You can retire with whatever your number is, 2, 3 million, 5, 10. It doesn't matter what your number is. But once you get there at retirement, suddenly you're no longer going to earn income ever again for the rest of your life. Hypothetically, that's the typical standard retirement. So faced with that proposition, if you know that you might be alive for another 20, 30, 50 years potentially, and all of the geopolitical risks and world wars and hyperinflation and market crashes and health events, all the things that could happen, if that's your last sum of money, whatever that sum of money is, you will be terrified to spend it. And you'll be terrified because you do want to leave your family a legacy. Even if you don't care about leaving your kids a legacy, you're at least obligated to your spouse to not spend everything down and leave something there. You typically want some stable sources of capital. You're afraid of long-term care events. And because of that, insurance shifts that risk. So otherwise, if all you have is a bucket of assets, an investment portfolio, you're essentially self-insuring. You're bearing all of that risk yourself, and that's wildly inefficient. So, I'm kind of bouncing around. It's a big topic, but buy term invest the difference on paper works for a while until retirement, and then you get to retirement. But if you have no guarantees in place, you'll never feel comfortable spending it. So for me, it's all about it's not this or that, which I think a lot of clients get into is, why would I do this when I can do that? And a proper portfolio does all of those things. It has a guaranteed component. It does shift risk, but it also has some upside potential. Heck, you can put some money in crypto if you want, a small piece of your allocation. Doesn't matter what you invest in, as long as it's diversified and spread around so that one piece of that portfolio doesn't wipe you out.
I think you put it in a really good position within your portfolio among everything else, right? It's not just, oh, well, I put everything 100% in the market, which unfortunately, if you look at probably 90% of the world or our country, when you look at their portfolio of retirement, 100% of it is in the market.
Yeah.
And when we think about your line of you're going to be too scared to spend, I think there could be some people out there that are like, ah, well, no, I don't think that's true. Well, there's a group that I'm a part of, and it's called the Lifestyle Investor Group. And in that group, we have a ton of people that are exiting their businesses. And one of the most common phrases that we hear among these business owners that exit is, "I'm afraid I'm going to spend all my money." Because for the first time in their life, what's actually happening is, and I'm going through this with a gentleman right now. He is making, $1 million to a year, but he's getting this check at the end of the year for about 20 million. And his conversation that we're having to walk through in his planning exercise literally is, Brock, I'm afraid I'm going to run out of this money because this is the end of it. Now, when you're in the jar, that could be the very thing, which is, oh my gosh, this is the last dollar I'm ever going to make. But we as business owners know that our human life value is the source and creator of all of our property value. And from that, we'll still be in the game. We'll still continue to provide value for others and build more income. Now, as it pertains to somebody's financial life, let's break down whole life insurance. So, in a nutshell, what how would you describe whole life insurance? What is it?
Whole life insurance is like owning your insurance versus renting your insurance. So with whole life insurance, you own it for your life. It will pay out when you die, not if you die. As such, it's a guaranteed asset. So there's a ton of value to that. So I think the difference is with term insurance, you buy a death benefit of say $1 million, and if you die in the next 15 or 20 years or whatever that term is, it pays out. With whole life insurance, you buy that same $1 million, but you know with certainty on day one that there will be $1 million delivered to your family at some point down the road, whether it's unfortunately tomorrow or if it's 70 years down the road. And typically these policies will grow, so that $1 million could be easily be $3 or $4 million by the time you eventually die. So the other component of whole life insurance, and this is where I think a lot of people, throw shade at it or just don't even understand the product, is it builds a cash value. And that cash value equals the death benefit by age 100, typically in most cases. So, and that's on a guaranteed and non-guaranteed basis. So there's a ton of value in that. It's effectively like owning a home. When you buy a home on day one, you don't really own any of it. You own whatever you put for a down payment. But when you calculate what you'll pay to move out of that house the next day in realtor fees, you actually are at a negative on day one. So it's the same thing with whole life insurance. On day one, usually there's very little value. You're essentially prepaying a lot of those costs of the plan up front. But usually by year 3 or 4, your money, the money you're putting into the plan is going directly toward cash value growth. So it's no longer a cost item, even though it's stated as a premium payment or a cost item. It's really a contribution to a financial asset that will one day return more money to you than you put in, either at death or while you're alive via access to those cash values. So that's the difference is, when I look at my policies, I'm only 43 years old, but I already get a lot of comfort knowing that my kids will be left better off than I was. And that's going to give me a lot of flexibility in my retirement to spend my assets down, turn my 401k into a pension with a guaranteed annuitized income for as long as I live, um,
Hmm.
and not have to worry about, separately also managing a portfolio to leave them that legacy.
So you used two words there that were pretty distinctive, which is guaranteed and non-guaranteed. So non-guaranteed side comes from the dividend, which I will talk about here in a second. But there's also the guaranteed side of things, and a lot of people get scared when they start hearing the word guarantee as it pertains to financial products. So in whole life insurance, it will be there. It is a guaranteed product. So where do these guarantees actually come from?
Well, they're baked right into the contract. So when a life insurance company issues, just call it that $1 million policy that will someday pay out permanently down the road, they begin to reserve assets against that eventual possibility. So they are statutorily required to hold a certain portion of that death benefit year by year to make sure that there is capital there to someday pay that claim. And it's basically built, if you want to talk about actuarial school in 30 seconds, effectively what they're doing is if they know that they are going to be paying $1 million at your age 85, they're effectively charging you what they think they should charge you so that they can put premium dollars in their piggy bank called their general investment account, earning some assumed rate, usually about 2 to 4% is what's used.
Mhm.
Um, and that's what builds the guarantees. They will actually guarantee you that outcome based on those dollars. And the difference with other forms of permanent insurance is the premium is guaranteed, the death benefit's guaranteed, and the cash values are guaranteed. It's the risk is 100% shifted to the insurance company to make that happen. So that guarantee component is huge, and it doesn't exist anywhere else. So there's other you mentioned universal life or variable universal life. Every other form of permanent life insurance does not have all three of those guarantees, and that's a key component of it. So that said, I think the non-guarantee component is really important to talk about, and that's really what when I say I'm a fan of this, I'm not a fan of whole life insurance as an entire category. I am a fan of whole life insurance issued by the biggest mutuals that date back to the 1800s, who and the word mutual is key, that operate for the benefit of their policy owners. All right. I think the misconception is that corporations are generally set up for the purpose of generating profitability for their shareholders at the expense of the consumer. All right. That actually is what the purpose of a corporation is to return shareholder value.
That's right.
Um, in the case of a mutual life insurance company, the word mutual means that they operate on behalf of their policy owners. I wouldn't say you're a part owner of the company because it's not like a share of stock you could sell to somebody else. That's why you
Hmm.
typically see it stated that way in marketing materials. But that's their charter. They operate for the benefit of their policy owners. There are no shareholders to take dollars away. So why I'm going into all this is the value is created when these companies out invest those minimal guarantees they put in place very easily. By the way, just with conservative portfolios managed well, they can do that. But you also get back, excess mortality. So when longevities increase and people live longer, you get back, some of those worst case assumptions that they made in their guarantees. And from the expense side too, as they manage expenses down, you actually get to participate in that. So that upside potential generated by a company that is chartered to operate on your behalf as a policy owner. Now I have a company with professional money management, in the background, sitting on the same side of the table as me. And
Yeah.
that's something that I don't think anybody understands about this part of the business. Whereas all those other products, those VULs and IULs, those are typically issued by those companies that are trying to maximize profitability at your
Right.
expense.
Now, right before we're going to move into the non-guaranteed side of things, on this guaranteed part of the balance sheet of our whole life insurance and even the non-guaranteed side, you talked about the fact that you want these companies that have been around since the 1800s. And I don't think people realize like how old these companies are. Like this is during the Civil War, the Spanish flu, like these
Yeah.
companies have outlasted all of these things. So when you think about this whole life insurance and the cash value, how safe would you consider this capital?
It's as safe as can be. All these big life insurance companies all have, the highest financial ratings from the financial rating institutions you can get, or the second highest, because they're holding so much capital. It's an actuarially sound amount. So they are actually reserving dollars based on the actuarial probability that you'll die this year. Um,
Mhm.
and and we're talking hundreds of billions of dollars just sitting basically in their bank account to pay claims. And on top of that, they typically will have another 30 or 40 bill. I'm just using some numbers from one of the carriers I know. Another 30 or 40 billion dollars sitting quite literally in cash. They call it surplus capital, just in case they need it, or if in case they want to use it to be opportunistic. So you can't kill these companies. They're the reason that they've lasted 200 years or going on 200 years is because you can't kill them. Between all the world wars, Great Depressions, market crashes, a major market crash doesn't impact a major mutual directly in their account. They're not invested that way.
Yeah.
Um, so I think that kind of answers. The longevity is not necessarily that important to me. I mean, companies could have been founded. Uh, in the 1900s and do just fine. It just happens to be that the biggest, oldest mutuals that are performing at the highest levels, have been doing it since then. I mean, we're talking about times when the South was marching on the North. I mean, we're not talking about modern times. This is way back in history, you know?
Yeah. 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 Now, do you know any stats of what it might have looked like or what these mutual companies did during, say, like the '08, '09, '10 crash? Like, how were they affected at all? Like, what has been your experience or knowledge of what happened during that time?
No, they were completely unaffected. The makeup of their general investment account is effectively bonds, long-term corporate bonds. They own some other things like real estate, mortgage loans. They treat policy loans actually as an investment.
Hmm.
Oftentimes, these companies will have wholly owned subsidiaries. So companies that are not in the life insurance business, but maybe in tangential businesses like foreign life insurers, retirement businesses, health insurance companies, things like that, and
Yeah.
those wholly owned subsidiaries kick off profitability too. So during a time of crisis, they're holding these investments to maturity, and because they don't need the liquidity, they don't there are no. It's not like a run on the bank. There is nothing that's requiring them to cough up capital. What happens is typically they actually do better right after, and we saw a major surge in whole life and major mutual business after 2008 because there was this flight to quality. People started to realize, oh wait, maybe I shouldn't have all of my assets in risk-based vehicles.
Yeah. Yeah. So we'll talk more about the importance of why being able to own a policy from a mutual insurance company that's buying these investments or investing this way is so much different and more valuable to be in rather than just being a retail investor and maybe just going towards bonds. So we talked a little bit about the dividends. So I think one of the biggest things that could be confusion within the whole life space is it could be touted as, oh, well, this company gave me a 6.1% dividend or 6% dividend. But then when you walk through the policy with an advisor and they're walking through it, you're not actually getting 6%. So could you help us walk through a little bit of like, what is the dividend? How's it made up? And why are these numbers different?
Well, there's life insurance isn't free. There's expenses in it. So when you think about if you're an insurance company issuing these contracts, you've got a legal team, you've got a marketing department, you've got the team of actuaries, you've got salespeople, you've got all of the things that the service department, all of the things that go into being a company and issuing products like that. There are expenses involved. So those will come out along the way. The other piece is mortality. There actually is something called a mortality charge, which is your effectively your probability of dying that year. So in the early years, it's very little, but there is a charge inside. So life insurance isn't free, but the way I describe it is if a company says they're paying a 6% dividend, hypothetically, and life insurance was free, you would see your cash value growing by exactly 6%. But just like in an investment portfolio that's professionally managed, if you get 7% in a given year, you're really only getting about six because after the investment management fees come off the top, that's your net return. Same thing with whole life insurance. In the early years, it's pretty pronounced that they tend to be front loaded in those costs. The insurance company's recouping a lot of that initial capital, so that in the out years, you're going to see your policy growing uh, at higher and higher rates closer to that dividend. So in that example where what I always point people to is forget about those early years. That's essentially the cost of doing business. A, you have to be healthy enough to get it. Uh, and then B, you have to be patient enough to see those economics start to pay off. But usually once you get past, the break even point, your policy will be growing at about 80 to 90% of that full stated dividend, which is and guaranteed to go up in value every single year. The only question is how fast. Unlike basically everything else you put money in except for cash.
Right. Right. So your study talked a lot about using this policy as a volatility buffer and having the permission to spend. So, what did your study find?
Well, I'll put it this way. So the biggest risk in retirement is the sequence of returns. And what I mean by that is we all know negative years are going to happen, but when they happen is super important. And the worst time for you to see a big market loss is right before you retire or right after you retire. And the reason for that is, especially right after you retire, if you start with a nice, juicy, big investment portfolio, you got all the money in the world, and then the market goes down by a significant amount. Say you lose a third to 50% in the market, which does happen routinely, actually, where you lose that kind of money in the market over a short period of time, and then you have to live. So you sell some of those investments to spend. Now you've exacerbated that loss and made it even worse. And what happens is once you dig a hole, yes, the market has historically recovered, but because you're taking income from it, you're making the losses worse and you're making it almost impossible to catch up. On the flip side, during your working years, that doesn't really matter all that much. When you lose value in the market, that's fine. Just you continue to work and add capital, and it will recover. So the strategy that you just mentioned, the volatility buffer strategy, basically says if we didn't have to kick our portfolio while it's down, if we didn't have to sell low, to raise capital to live off of, because we had money somewhere else in an asset that we could call the volatility buffer, um, then we could allow our portfolio to recover. So what would you like that asset to look like? Well, typically you want that asset to not be correlated to the market. That asset cannot be going down while everything else is going down. And by the way, real estate or home equity could work, but that's not guaranteed at all. We've seen housing crashes that could absolutely be happening at the same time that the economy is imploding. Um, so that's not necessarily that. Cash actually is and has been used by the investment world in the past as that for that strategy. A loan from rich Uncle Steve. I don't care where the money comes from, but just having somewhere else to get money from. And the reason whole life insurance is a great fit for that is because it actually has historically given you bond-like returns with guarantees to increase every year, but it's also fully accessible. Typically, when you think about where people put their money, like retirement accounts, 401ks, there are penalties for taking the money before 59 and a half. There's required minimum distributions. They're hugely taxable at the highest rates possible. There are no tax advantages on the way out of those plans. So whole life insurance kind of gives you a way to mitigate the risk on all those fronts.
Right. And I think one of the things that you do a really good job of is the fact of, as you are an investor, one of the things that you want to be able to do, especially going into retirement, is creating this fixed income portfolio, right? And you talk a lot about the fact that there's really four distinctive risks, which are credit. What's the risk on the quality of borrow you're going to take, the duration, right? The taxation, and then liquidity. And then there's two other questions that I think are really important for people to ask on this which is, what's the correlation that you want between your stocks and your bonds? And ultimately, how complex or comprehensive do you want to get to enhance just the overall portfolio and it just become more and more complicated? And
Yeah,
what you talk a lot about in that is the whole life insurance is a incredible solution for this because it's a simple, straightforward product. It has zero correlation to the stocks, and you're able to use it for um, longevity within your retirement income, but also have it as that volatility buffer to say, hey, we don't have to kick our portfolio while it's down, and we get to use it as our my favorite analogy that you use, your reliever, right? So
yeah,
could you talk a little bit about that baseball analogy that you talk so much about?
yeah. And there was a point came to mind as you were just talking there. And just to keep it super simple, and this is how I've just explained it before, is every asset with a good return over time will carry risk. So equities carry risk. We all know other things like Bitcoin, of course, carry risk. Home equity carries risk. Bonds, to the shock of many investors, carry a lot of risk. A lot of investors saw how much bonds could lose in 2022 at the same time that equities and everything else was going down. And you can't be in that situation in retirement, because again, once things go down and then you make it worse, it just becomes impossible to dig out, especially if you need ongoing income. The great thing about whole life insurance is it guarantees that you have a piece of your portfolio that you're always selling higher. Buy low, sell high. That is the number one rule of investing, right? So if you always have something that's higher than the year before, you can always be selling high. So that's an oversimplification, but that's the mentality.
Right.
Um, so what was the question again about the retirement strategy?
So you talk a lot about the fact of the analogy with having a reliever, right,
Yeah.
in your pitching, in your bullpen. So why don't you walk through that pretty quickly?
Yeah, so I mean, whether you're a baseball fan or not, you kind of understand that general theory in baseball is that the starting pitcher in the first inning against the first batter can go out and throw as hard as he possibly can, throw the nastiest curveball he possibly can, just trying to get that batter out one pitch at a time, not worried about the rest of the game or how long he lasts. When you think about that, what gives him permission to just ignore the rest of the game and just focus on one batter at a time without worrying about if he gets tired or hurt? And the
It's the
obvious
relief.
answer is the relief staff, right? There is an army of men out in right field warming up, desperate to come into the game and prove themselves and step in. And in fact, that's optimal baseball strategy typically is, you'll see a starting pitcher go for 5 or 6 innings, and as soon as they get tired out, you bring in the fresh arm. But the analogy that I use is how differently would that starting pitcher approach those early innings if he knew that he was the only pitcher on staff. He had to pitch the entire game, even if it went 18 innings, 5 or 6 hours into the night. And if he couldn't because he got tired or hurt, they would forfeit the game. Right? He'd throw a heck of a lot lighter. He'd be a lot more timid. That curveball would be way less nasty, and home run after home run would be hit, and it would be a suboptimal performance. And effectively, what I'm describing is how retirees are entering the first innings of their retirement. All the many investors, all they have is an investment portfolio, and they don't know how long that investment portfolio is going to last because they don't know how long the game is going to last. If they're going to be dead in 15 years or 50, and all of the things that can come along the way during their retirement game. So that said, how differently do you think they would approach retirement if they had a reliever in their portfolio? If they knew if they did happen to retire into the worst case scenario and there was a world war 3 years into their retirement, or just fill in the blank of bad things that could happen, if they had some relief asset that would put guarantees in place so that no matter what, they're protected. They would
Yeah.
they would spend a lot more aggressively. They would stop under enjoying those early years of their retirement and
Hmm.
maximize the income that they could live off of, which again is the stated goal of retirement accounts, right? They're not
Right.
all that tax efficient. They're a place to store wealth so that you can live off of it someday down the road, not transfer assets to the next generation.
Yeah. And I think, my younger brother is a Division 1 relief pitcher. And we get to talk a lot about that because of the fact of, those pitchers, those starting pitchers are going out there and because of the fact that they don't have to worry about later in the game, they get to focus all of their energy and all of their attention on what's right in front of them because they know that somebody else is in the bullpen just biting, ready to go in and take care of the rest of the job. And then even he can go out there and really get after it because at the end of it, he's got somebody else behind him as well. And so I
Right.
think that's a really important to analogy and one of the best analogies I think I've ever heard around it because of how important it is to have that reliever in your back pocket. Because one of the things that I don't think enough people know is, the typical portfolio that most people have, and one that has been touted as the best portfolio, was the 60-40 split 60% in equities, 40% in bonds. What they probably don't know is the fact that it's like the worst performer in the last 100 years for the last couple of years. And we're starting to move into this different world in our wealth sphere that people have got to really start taking a strategy approach rather than just all it is just a product approach, right? So we've talked a lot about the cash value, why it's a really good job that why it's really great idea to have it as part of your portfolio, especially your fixed income portfolio. But one key aspect is the fact that we all live until we don't. So when we look at this whole life insurance, there is a death benefit to it. Is there really any value in the death benefit, Tom, or is it just, hey, we're all about the cash value?
No, I think the biggest reason that people don't understand this is because they focus on the cash value, which is frankly kind of irrelevant. It First of all, my research has basically proven that over time, and it makes sense because of the way they invest and how I've talked about it already, that whole life insurance should give you a bond-like return over time because it's backed up by and the performance is based on a giant bond portfolio. managed in the best way you possibly could manage one by a major institution. So the value of it from a cash value standpoint is that you're getting bond-like returns, but the company has completely eliminated the risk. They've indemnified you from the risk and given you guarantees that your value goes up no matter what. So if you can get a bond-like return, but none of the risk, which you would bear on your own, now you got a better bond. As long as you have enough time frame, like as long as you're looking at it in the proper time frame, not a year or two, but you're looking at it as a decade or two or longer, which is the appropriate planning time frame. All that being said, though, is I don't really care the rate at which my whole life policy cash value is growing. As long as it's growing at a reasonable rate and it's accessible to me, that's the piece of the portfolio. Where the death benefit comes in is I heard a brilliant phrase from one of my guests on my program, who described it as the guaranteed delivery of future money. And he basically said the guaranteed delivery of future money, the death benefit, I know it's happening, is just as valuable as having that money today, as long as you have assets or credit available today to use against that eventuality. And here's what I mean by that. If I know my kids are going to get $1 million to split, or whatever the number is, that means I've got $1 million in my hands today that I can just completely squander. I could just bet it on black if I wanted to and know that my kids are still taken care of. Now, that's not my suggestion for a retiree, but you get the point. Like, I know that that goal of mine is set. Similarly, because that policy has an available cash value, I know that I can keep that $1 million that's in my investments invested in the market, because if it goes down, now I've got a bucket of money to pull from to let my portfolio recover. Whereas an investments only investor, the prudent strategy actually is to exit the market in the years leading up to retirement, because you can't lose half your money the day before you retire. Like that actually is, the asset allocation model of most people, which is completely counter to how compound interest works. You want the biggest amount of capital at the end of your life to be exposed to real upside. Um,
Right.
so I think that the value of the death benefit is is that you've shifted risk. Is that that is going to happen. You've created the backstop. You've created that additional source of capital. And now you can go spend or annuitize your assets. Annuitize meaning, turn it into a pension.
Right. And we get to talk about the fact that when you get into those distribution phase years, you get to spend and enjoy your money without the fear that you're going to run out of money. Right. And that's like the biggest piece, which, more and more people are running into, because we're finding out people are living a whole lot longer. Not necessarily a better life, but we're definitely living longer. And so having that reliever there, that backstop of the death benefit, gives you that permission to spend like your book talks about. So as we think about this, you know, I think we've harped on a ton about the fact that you as a retail investor are not going to get the same amount of performance as you would if you were an institutional investor. And the way that you can pick up some of those institutional type investments or bond like returns would be through whole life insurance, specifically with a mutual insurance company, because of the fact that they have billions of dollars a year flowing into their pockets to then be able to perform well within their portfolios to bring back to us through that whole life insurance.
Yeah.
Now, saying that, you could on the flip side have somebody that's extremely wealthy that could be saying, well, yeah, Brock, I'm worth 20, 50, 100 million, 200 million. Why would I need whole life insurance? Because I could probably go get those returned somewhere else.
Well, gosh, it all depends on how they accumulated those millions. If if that net worth is tied up in a business, there's a tax issue. So at death, there's something called the estate tax for estates that are worth over, next year it'll be 7 million. Now it's 14 million per person. So if you owe an estate tax, that estate tax, a lot of people don't realize, is due effectively immediately. From the IRS, it's within 9 months, and on state governments, it's also pretty accelerated. So, you know, you die and now there's this estate tax generated, and your estate now owes a tax. And if there's not liquidity, meaning there's actual cash to pay those taxes, and I have not found a lot of wealthy investors that are just sitting on $50 million in cash. It's usually tied up in a business or real estate. You're going to have to start selling off, fractional pieces of your business at fire sale prices. or real estate at fire sale prices to raise capital to pay the government,
Right.
versus handing your legacy to the next generation. So insurance is a really great way to do that, to create liquidity for those events, and those unlikely events. But in the more likely event that you live a while and don't die young, uh, because they're guaranteed to grow, you're generating value just like you would other investments, but without the risk. So I
Right.
think I think I've actually seen the greatest appetite for this stuff at the highest income levels, even though it seems like a paradox. Like I don't need insurance anymore. I'm wealthy. It's
Right.
actually at that level, it becomes very much about a want and what I want my legacy to look like, what I want my estate to look like, versus a need necessarily,
Right.
right? I mean, at the end of the
Right.
day, that person dies, everyone's still rich, right? It's not
Mhm.
it's not a need. It's how what do I want, my legacy to look like?
And one of the things that, as you were talking about that, we talk a lot about most people. You can look at the studies. Most millionaires are not inherited millionaires. Like they are self-made, majority of them, which
Mhm.
states the fact that most people's wealth grows over time. They're on this exponential curve, right? And something that you talked about a little bit earlier, and we kind of brushed over it real quickly, is the fact that this isn't something that you want to do like 2, 3, 4 years right before retirement. Like this is something that you want to plan in intentional and diligently about early on. So, for myself, me personally, I can say that I started my first policy when I was 18, got another one when I was 23, about to get another one this year, and I've got the term insurance to back it. So, from your standpoint, why why would somebody, or is it a good idea for somebody who's much much younger to start this, say in their 20s or 30s, early 30s, to start this planning rather than just waiting much longer?
Oh, 100%. I mean, it's like a universal rule of life. The earlier you start something, the better off you will be, and that applies to pretty much everything universally. So, yeah, the younger you start it, the further you are away, actuarially speaking, from death. So, the internal expenses are pretty low. Your dollar goes a very long way. You have more years to fund it, but at its core, compound interest is on your side. So if you can get into these plans early, at low rates, you'll start to see compound growth, at tremendous rates.
Yeah.
So yeah, it's just like buying a house. If you can get into real estate young, it hurts a lot up front, or it may feel like it hurts, but very quickly it starts to become one of your biggest assets, that can be
Yeah.
leveraged all kind of other opportunities along the road. So no,
Yeah.
I think young folks should be doing it all the time.
Yeah, absolutely. So one last thing that we'll touch on here before we wrap up is the fact like life insurance is becoming a really hot topic on social media. Everybody wants to talk about it and share it with other people, right? So
Mhm.
one of the biggest things is how do you maximize the cash value as much as possible? Now we've just talked about the importance of the cash value, but we've also just talked about the importance of the death benefit. But as you're designing one of these policies and you're working with an advisor, hopefully that can show you their own policy that they're doing for themselves because they're practicing what they preach. Why might it not be a good idea or a great idea to minimize your base premium as much as possible so that you have the most amount of cash value in year one rather than maybe having a higher base for a longer period of time as you start one of these plans?
Um, yeah, for me, I don't understand the overfunding all that much. Um, I don't understand why people do it. Typically, what they'll do, it's frankly a lot of the time it's the advisor just afraid of pitching a product that has a low early value relative to what's been paid in. Um, I'll start at the end. At the end of the day, the only number that matters, the only rate of return that matters in a permanent life insurance policy is what they call the internal rate of return on the death benefit. Basically, what is the effective pre-tax rate that you would have had to earn elsewhere to mimic the death benefit that gets paid out? And even if you live 40 or 50 years, you'll find that you'll probably need to get 7 to 10% in a taxable world to equal, what you would get in a tax-free death benefit. And the reason I say that that's the only number that matters is because these shouldn't lapse for the typical client that we're talking to who has a six-figure or multi-six-figure income and will retire as a multimillionaire to some degree. Maybe that's only two or three, maybe it's 10. they're going to be fine and they have stable incomes. So those early values feel good to them because they can see it, they can touch it, it's there. It takes that fear of making a bad decision away from them early on. But usually those early values come at a trade-off to that highest possible rate of return on death benefit. And why I say that's important is because the only people where that death benefit rate of return doesn't matter are the people that quit, or the people that are literally broke in retirement, spending their dollars down to zero, deciding they don't want this life insurance at all. They don't love anybody else in the world or want to leave money behind. And I've never seen that. I've never seen that to be the case. Even widowers typically will have some kind of inclination to leave money to somebody else. So,
Right.
and the other piece is, when you overfund these contracts up front, yes, the early cash values look really good, but on a long enough time frame, all of the policies, whether they're overfunded up front or minimally funded up front, they all have basically the same rate of return because they're all based on the same investment portfolio from the same insurer. So I don't really buy into that philosophy all that much. I get it.
Mhm.
There's typically a crowd called the infinite banking crowd, or that will talk about, overfunding a policy up front heavily and then immediately taking loans to go fund some real estate project and then put the money back into the policy. And don't get me wrong, I use my policy like a piggy bank. I mean, I take policy loans every year, if not more often than that, to do various things. I don't think I've had a dollar in a savings account for like 16 years because I've just used my whole life policy that way. So I believe in the philosophy, but my policy is just a basic pay all years, pay to 100, maximum death benefit design because I'm never going to cash out. So the rate of return on the cash is frankly irrelevant to me unless I'm going to cash the thing out and quit. What difference does it make if I earned 4 or 5%? It's so that's my kind of take on it. Is I think it's a lack of understanding. It usually comes from a good place, but it's frankly just a lack of understanding of the long term economics of these plans and why they work so well.
Right. We got to have a long-term vision on this. Now, some people of what we just talked about might bring up direct versus non-direct.
Mhm.
Do you have anything to say about the direct versus non-direct and why some people might say one's better than the other and you shouldn't do one? What do you have to say to that?
I drank the non-direct recognition Kool-Aid for years in my career, and what I'm talking about, and if you're not familiar with what that works, basically what it means is for a lot of insurers, when you take a loan against your life insurance policy, non-direct recognition means that they will not directly recognize that loan as existing. So basically, you take a loan, you've got your policy, the loan will, if you don't pay your loan back, that'll grow. The whole life policy will grow as it would have otherwise, and the loan is just kind of against that policy. With a direct recognition contract, you'll find that if you take a policy loan, it will actually impact your dividend performance. You will actually receive a dividend slightly lower, or a dividend rate slightly lower than the rate you're paying on that loan. It used to matter. All right. So if you look back into the 2000s and the 2010s, it mattered as interest rates were falling. People were actually able to borrow at rates lower than dividend interest rates were paying. So policies looked really good from an income standpoint when you could be borrowing at rates below what you were earning. But now that we've bounced off the bottom, and even if we continue to dance along the bottom of the rate environment, those economics are kind of gone. I don't really see an environment in the near future, meaning the next couple decades, where that's going to be to your advantage. And in fact, a lot of companies that have direct recognition or fixed loan rate regimes uh, probably will perform better, for the foreseeable future. So I was always in that camp that, as somebody that worked with a major mutual company that had non-directed, I was like, that was our badge of honor. But years later, now that the rate environment has shifted, I personally believe it doesn't really matter at all, and it's probably going to be a wash for no matter what you're doing.
Right. Yeah, I'm with you. All right, Tom. I think that was good for today. Where can people find more about you and what you're doing and what you're up to?
Yeah, if you're an advisor, you can check me out at wholelifemasterminds.com. I always find LinkedIn is actually probably the best place to follow me. That's typically where I'll post a lot of my what I'm up to, or just some thought pieces along the way as I find time to do that. Tom Wall Talks on Instagram. The book is permissiontospend.com. So it's on Amazon, but if you go to permissiontospend.com and you have clients, it's a great handout for clients. It's frankly why I wrote it. I didn't write it to become a rich author. Everyone knows you don't write books to make money. I just wanted to create a resource that the advisors I worked with could hand to their clients that was objective from a third party that had research backed ideas in it that was basically retirement planning 101, but supported these concepts of shifting risk and putting guarantees back into a world that doesn't really have them anymore.
Awesome. Well, we'll be sure to add in the show notes the link to get the book. And then for agents, advisors, if they want to join the mastermind, they can. I fully endorse it. I think it's one of the best that you can be a part of. I'm watching it weekly and on the calls weekly. So I really like it. I really enjoy it. I'm glad that you're doing it. Is there anything else that you want to add before we wrap up?
I don't think so, but I think the takeaway is investments only doesn't work. All right, there's the reason that there's multiple financial assets out there, and to the extent you can blend them together, you will be better off than the person who just builds up a portfolio alone.
That's right. You will be a better investor by having those guarantees in place somewhere else. So, Tom, thanks for being on. I'm so glad we got to have this conversation, and I look forward to more.
Likewise, thanks for having me, Brock.